I've been around for a while, as some of you know. There's a number of you in here that were clients of mine before I declared my independence and became an independent financial advisor back in 2001. But we have 14 and a half years of track record. Now, technically, I'm not supposed to show this because technically I wasn't on my own. I was working for Scott Walker for about a year and a half, but I was managing your money all through that time. So technically my official record starts in 2002, but those of you who know me, some of you know me since 1985, know that I started managing money independently for you in early 2001. So there's a 14 and a half year track record. By most people's count, that's a long enough period to figure out if somebody knows what they're doing. And you're all still here, so I guess you decided I do. Over that 14 and a half years, we've averaged an annual return of 6.9%, and it really frustrates me. If this was 3 months earlier, it would have been over 7%. When you compare that to a pure investment in the stock market, if you put all your money, which nobody does, I hope, put all your money into the stock market at the same time, you would have averaged 5.6%. So we've significantly outperformed the stock market. And the volatility thing is the big one to me. Stocks have had a standard deviation of 9%. Now, what does that mean? If you're not a statistics buff, it means that in a normal year, the stock market will swing 9% in one direction or another. So with roughly a 5.6% return, in a normal year, you expect the stock market to make you about 25% or lose you about 5%. That's the swing factor around the stock market. I'm quite proud of the fact that our volatility has been quite a bit lower than the stock market, 6.6%. Now, I have failed in my original quest. The original goal was to capture 80% of the upside of the stock market. All right, I never claimed we would beat the stock market. We were going to capture 80% of the upside, but with half the risk. Well, I failed. We did better than the stock market, but we did have about only 27% less risk. So you decide if that works for you or not, but it's still not a bad track record. And put another way, if you'd put $100,000 in with me, or into the stock market, let's say, 14 and a half years ago, it would now be about $223,000. And that includes the reinvestment of dividends. That's all in. If you'd invested in real estate, this is a rough number. Residential real estate, your $100,000 would be about $150,000 now. If you'd invested in what I call the peace of mind portfolio, which most of you have, you'd have about $266,000. So the numbers may not sound that exciting when you say 6.9%, but when you compound that over time, it's a significant pickup from what the stock market has done, and in most cases from what a lot of other investments have done as well. And I also have a graph of that same thing. I'm giving you all this perspective for a reason. But this is the mountain chart. The blue area is what a composite of our portfolios has done over the last 14 and a half years. $100,000 up to about $266,000. The red line is the Standard & Poor's 500, which is pretty much the U.S. stock index, and it hasn't done as well. It's great to say we've done better, but I really want to point this out. And the reason I want to point this out is if you stay with me, somewhere in here we're going to go through a bear market. All right? What I really do well, or what I hope to do well again, is protect you when things go down. In 2002, after 9/11, after the technology bubble blew up, we had a significant dump in stocks. People forget that that market fell about 35 or 40% that summer. We were down, but nowhere near as much as the stock market. And I don't have to tell you that during the onset of the Great Recession, 2007 to 2009, we had this huge sell-off, a 57% decline in the average common stock holding, and most mutual funds were down more than 50%. We were down, but we were down only 23%. And I remember feeling embarrassed about that until I looked at what the stock market was doing. So what's important is that people don't make foolish decisions. When things are bad, everybody in the media is going to tell you it's going to get worse. There'll always be some learned economist telling you why. You know, Bill Gross, if you remember Bill Gross from PIMCO Total Return Fund, right at the bottom, he was opining that stocks were going to go down another 50%. He's not a stock guy, and he was dead wrong. They turned around and came back. My job is to keep you in the market when things are that recession with a large cash position and a large bond position. And then we started picking up bonds when people were throwing out General Electric bonds with a That's when I like to have some cash available to start buying. Why am I telling you all this? Well, because probably most of you lost money with me this year. We made about 14% last year, but we gave back a little, single digits. But I want to remind you that 1 year does not make a long-term performance. What did we have to work with? This is the stock market from a year ago. Here it is today. Virtually unchanged, just a lot of sideways movement. Okay? And we had a significant correction during the summer. This is the interest rate on 10-year Treasury bonds. Pretty much the same as it was at the beginning of the year, with quite a bit of oscillation in between. Okay? So I've had to steer through basically what was a market going nowhere. International equities gave us very little room to work. As you know, we had that Lazard International Fund. I finally got rid of it a couple of months ago because I've gotten more nervous about some of the things going on internationally, particularly in the developed countries. And sure enough, it has been down. And we're not in it right now, but we do own a number of companies that sell internationally, so it's something we've got to watch closely. But the big story this year was anything to do with real assets, with commodities. Gold, silver, steel, iron, lumber, you name it, coffee. All right, and of course the big one, oil and gas, have really gotten hit this year. And it was just a disaster. And this is a continuation, by the way, in a lot of those commodities from a couple of years ago, from 2014. We had, importantly, the first true correction. It was a brief one, but in case you didn't notice, during the summer, the U.S. stock market fell 15%. That was the first time we've had that big a dump since back in 2011. And people, I find, have gotten very complacent, and sure, we know we have these wiggles, but overall, we've had a huge move upward in the stock market with some of the lowest, actually with the lowest volatility of my career. Typically, the stock market varies something like 17% year to year. If you remember, I just mentioned in the 14 years I've been managing money, almost 15 years, the stock market has had a volatility of only 9%. That's very, very low. And so suddenly we get these sell-offs and people go crazy, get really scared. And what we have on Wall Street, I think, now I'm in my 60s, I've been around a while, we have a generation of people on the trading desks, in the advisory field. I mean, everybody I look at television now who is a so-called expert is younger than I am, and they haven't been through, some of them, a real sell-off. And they tend to overreact. So part of what I hope to bring to the equation here is a bit of gray hair and a bit of experience and a willingness not to overreact. We have any number of very successful stocks that right now are up, are making us money. We haven't sold them out. We're holding on to them so far. Apple made a new high early in the year. It's kind of struggled during the year, but if you remember, I bought Apple in early of 2014, I believe it was, because I said that this is converting or going to convert from a strictly growth stock to a growth and income, a more mature company. Everybody expects Apple to keep coming out with these whiz-bang products, and perhaps they will, okay? But the real story here is they have oodles of cash, and they're raising their dividends, and they're buying back stock, and they're the kind of company that I like to own in what I call the peace of mind portfolio. Something you can count on, like a good tenant in a rental property, to keep paying you dividends, to keep paying you income. And Apple is in very good shape to do that. Okay, so we're hanging on to that. Public Storage has probably been our best performing stock, interestingly enough. Not a real glamorous story. You know, they run storage places, right? I saw the Campbells earlier this week, and we were chuckling about how everybody seems to hoard stuff. I mean, I still have my dad's paintings. He's been gone for 14 years, and I still have them in storage. And cleaning out and getting rid of stuff is the toughest thing anybody seems to be able to do. So these guys are able to raise rents and store stuff for people. But realistically, what I also think is going on is you have a number of people, a lot of people lost their homes during the Great Recession and have not been able to buy again, but they're holding on to their furniture. They're holding on to their possessions. You've got what I call the millennial generation. Kids in their 20s to early 30s that are getting married, starting to have kids. Well, a lot of them are living in apartments, etc., and they will be storing stuff as well. But in any case, all I know is they pay a big fat dividend, and the stock is near an all-time high. MasterCard is a play on the general health of the economy, which I still believe, particularly here in the States, is quite healthy. Basically, they make a little, a few cents every time somebody uses the card, every time there's a transaction. And there's been plenty of those. Retail sales are doing extremely well. Goodyear Tire, another boring company, right? Why did I buy it? Well, as I did some homework, I found out that the Chinese had been dumping tires in the States. We put tariffs on them, which went into effect in the spring, which is helping Goodyear and other American-based tire companies. But in addition, the raw materials that go into a tire, which are rubber and plastics, which are a byproduct of oil, the raw material prices are way down on both rubber and plastics-based, energy-based plastics. So their profit margins are doing well. Now, I'm not sure how long we'll hold on to this. This is what we call an economically sensitive stock, but auto sales are booming right now. It's real good for people at Goodyear, and people are willing to spend to keep their cars up. So far, so good. Preferred stocks has been one of probably the most solid things we've owned. A lot of you remember when well, you've all had bonds, and you remember when I was picking up a lot of bonds during the Great Recession. People were throwing out high-quality bonds, and we were able to get really great yields. Well, unfortunately, in the subsequent 6 or 7 years now, these companies that were paying 6, 7, and 8% dividends or interest on their bonds have been buying them back. They've been calling the bonds, as we say. Just like your neighbor, and perhaps you have refinanced your mortgage at lower rates, that's what corporations do. And they can go out and float a new bond issue at 3%. Why leave a 6% bond out there and have to pay interest on it? So we've been losing our bonds, and it's frustrating, but all of you are probably seeing notices that such and such a bond was called and delivered out of your account. It's not because I sold them, it's because the issuer bought them back. The substitute that I've been using is preferred stocks. They occupy this range in a hierarchy of corporate financing between bonds, which are the safest, and common stocks, which are probably the most risky. A lot of people don't think of it that way. But if a company does wind up in liquidation and financial trouble, they have to pay off the bondholders with whatever they have left. Those are the senior securities. Then they have to pay off the preferred shareholders, and only if there's money left or assets left do the common shareholders get anything. So preferreds are, in a sense, a little more risky than bonds, but I do my homework. I look at the companies that we own, and most of them I think are quite solid. And we're getting 6.75%, some cases 7% yield still on preferreds. They're getting darn hard to find, but I have a service that alerts me sometimes when there's a new issue, and I can buy them over the counter before they get listed, and we can get some pretty darn good deals. So those have been replacing our bonds. I'm going to talk about American Tower a little bit more later. And I won't get into all the details here of every position we owned and closed and bought and blah, blah, blah. But basically, we closed a lot more things with a profit than we did with a loss. Okay? We reduced Apple. And I got calls from some people and saying, what are you doing that for? You know, everybody loves Apple. But if you remember, it was up at around 132. Now it's down to about, what is it, I think around 118, 119. It's not a big drop, but I noticed some things technically that said to me, all right, the bloom is off that rose for a while. I'm not sure what's going to kick them up further. I think the stock probably is a pretty solid hold. But part of what I do when I'm watching out for you is to sometimes over-allocate, sometimes under-allocate, depending on what I think is coming along. I'll mention something that might puzzle you, and I am going to talk more about Kinder Morgan. You see, I show it as closed with a profit, and I show it as closed with a loss. It all depends on when you bought it. For the vast majority of you who've owned Kinder Morgan, some of you since 2003, you booked a very big profit, even after the stock started falling significantly this summer. For those of you that got it in the last 3 years, you probably took a loss. Okay? And I will talk about it. What they own is fabulous. The way they've been managing it has not been so fabulous, and that's why the stock has been struggling. A couple I'll mention. Oh, I also had reduced in late 2014 Enterprise Products, which has also been hit hard as part of the energy sector. But my intention is to hang on to Enterprise. Put it this way, they are like an interstate highway for oil and gas around the country. If Enterprise's system was to shut down, we'd go into a national recession. That's how important they are. Okay? People, in my opinion, have made a mistake in not distinguishing between oil drilling and oil production companies and those that transport it, that are toll roads. Now, Kinder Morgan historically has been that, as has Enterprise. We've owned Enterprise since about 2008. Both of them have gotten hit, but Enterprise has not fallen anywhere near as much, and they're managing their capital much better. Kinder Morgan, return on equity 4.5. Enterprise Partners, return on equity 14.5. A stronger company. That's why I'm still holding on to it. But I did reduce some late last year because I saw, as we talked about last year, this fall off in energy being worrisome, and boy, it has been. We were in and out of U.S. Bancorp. We took a nice profit on it in, I think, January. I like the banks. Somewhere in here the banks are going to come back as the economy comes back. But the government is keeping such a tight thumb on the lending institutions and watching them so closely that it's hard for them to make really good profits. And frankly, low interest rates, it's hard to make a net margin spread. With interest rates rising, with the Fed likely to raise interest rates, is it next week? the banks should start perking up. And U.S. Bank is probably one of the most solid banks out there. In fact, the gentleman who told me about the bank is sitting here, Dick Swinney, who used to work for them and got me interested in the company. And the couple we sold at a loss, the big one that I just kind of kicked myself is Priceline. I like them conceptually. World travel should be up. There are rising middle classes, particularly in China, and Priceline bought an interest in a Chinese online service, etc. But the stock really got hit hard, and at some point it was more of a technical decision. I got out of it, and of course then it bounced back. But essentially it really hasn't made any progress this year. Goldman Sachs, they tend to be, I don't know, I've been in and out of that, as you know. I don't think we've ever made money on it. I like them, they're the brain trust, but it's harder for them to make money anymore. They're really more like a traditional bank than an investment bank. Investment banks have pretty well gone away. And it's a graph, everything's adjusted to 2014 dollars, so it's pretty current. But it goes back to 1970, and it shows the price, I think it's a Brent crude, of oil, and the various things that cause these changes, these spikes and these declines. And of course, we all remember the 1970s and the gasoline lines, and you could only buy gas on alternate days. And I don't know if any of you lived in the Northeast at that time, but I remember going into restaurants wearing an overcoat because they didn't have the heat on. And you know, it was bad. And then we had the big run-up, Arab oil embargo. And then what happened here in the late 70s and 80s? We had this tumbling of oil prices. The rise in the price of oil drove people to go find more. And where did they find it? In the North Sea. Tons of it in the North Sea, Alaska, and other fields were opened up. When the price goes up, it becomes economically attractive to go to the most ugly, difficult climates on the planet. Go drill down, a mile and a half under the ocean and get the stuff. It's amazing technologically what the industry can do. And this is what brought down the price of oil. What I want to note is how long the price stayed low. Sure, we had these spikes and all, but we were all told in the 1970s that we were going to run out of oil, that it was going to go to $200 a barrel, blah, blah, blah. For a generation, oil stayed cheap. And finally we got into the current millennial, if you will, and we started to see a rise. Why was that? There wasn't a whole lot of new drilling because the price was low, and China came on as a factor. The Chinese economy started expanding, and you've got 1 billion plus people moving from bicycles to automobiles. And that's still going on. But that was really the big driver here. Then we had the big recession hit, the Great Recession of 2007, 2009. Economic activity slowed down. Down went oil prices, but they came right back as soon as we came out of that. However, what was also going on, which a lot of us were not aware of, Rich Kinder was, from Kinder Morgan, was this amazing technological miracle that was developed, where else? The United States, of being able to squeeze oil out of these tight shale rocks that they were finding in places like North Dakota, going back into Pennsylvania, where oil was first discovered. We knew that we had shale, but nobody thought they could get oil out of it. And there's a book I read on this, it's fascinating, all the money that was spent trying to figure out how to get at it. And they finally started to be able to produce it roughly around 2003, 2004. Well, that's what I was saying to y'all last year was going to lead to a lower oil price. And this was last year. Where were we? Around $90 a barrel? Here we are down here at about 40. We're back to those old lows, and I strongly suspect we are in another one of these eras. It's going to be a long, long time before oil prices go way up again. We may have some spikes, but it does not look positive. I mean, it's great if you're a consumer, but not if you're a producer of oil. It's very tough. Iran hasn't even come back to market yet. Iraq has come back to market. So, sorry, Susan, but but anyway, what does that all mean? Well, it affects certain companies, and trying to navigate our way around that is important. And let me go back real quick before I start on Kinder Morgan. As you know, we owned a lot of oil-producing, oil drilling, or oil servicing, or oil-related stocks in 2014. And if you go back and look at your statement, you will see that I dumped most of those. Exxon we got out of, Devon, Laredo Petroleum some of you had. We had an ETF called FRAC. What else did we have? Anyway, we had a number of companies that were all benefiting from higher oil prices, and I started to smell that something was going to come. And in my opinion, don't believe the economists who say, oh, we'll see a balance and oil prices will come back in 2016 or 17. I highly doubt it. And why is that? Oil production in the United States is starting to curve over and come back down again, all right, because the price is low. But they can reopen They can frack wells and reopen them very quickly and very cheaply in this country. So as soon as prices go up, you're going to see production in the United States come back up. And the USA is now the swing factor in the global oil market. It is a global market. Saudi Arabia has lost control. We are the real swing factor. That's a real good thing for Americans. It's not a great thing if you're working in the fields in North Dakota and you moved up there, or if you're in Texas and you have a business that depends on a vibrant economy. So it's hurting certain parts of the United States. But overall, for people in this country, it's a good thing. All right, Kinder Morgan. This is a chart that goes back. We bought it in early 2003. This was Kinder Morgan LLC. If you remember, Kinder Morgan had three entities. Three. Kinder Morgan Corporation, Kinder Morgan LLC, and Kinder Morgan Partnership. For most of you, I did the LLC, and I won't get into why, but for tax reasons, it made more sense inside of IRAs and pension plans, and most of you have money with me inside of pension plans. What we see here is, and I don't have to tell any of you who were in for that ride, it was a fantastic stock. And I held it through the Great Recession. I had a lot of faith in that company, and it's a good thing we held it because its best days were after that in the last few years. It had a huge run up. This gets up over close to a 500% move. It's the greatest stock that I've ever owned for clients consistently. We had it for 13 years. And then things started to happen. Late last year, Kinder decided to do what they called a roll-up. They bought back the KMR, they bought back the KMP, they rolled them all up into their corporation, and they did that because they said, we want to be able to borrow money cheaply. It's too confusing for the lenders. There are all these reasons they had, which I kind of was a little uncomfortable with, and I was really uncomfortable because it caused a big tax bill for some of us, including me, when they did that. But I stayed on board, I watched it, and the stock continued into 2015, the converted stock, to make a new high. It went up another 10%. Then it started to tumble down. It wasn't that bad, but when we got into the middle of the summer, it broke some chart points here and here, and I got very uncomfortable. And I started lightening up for some of you as early as June, a few of you in July. And there was a report that came out that started pointing out that the company was really not covering their dividend, was borrowing a lot of money, and was trying to juggle too many balls at once. Essentially, that they were trying to build all these pipelines, which takes a lot of capital investment, and they had sunk a lot of money into some, particularly up in Canada, that they were having trouble getting approval for. They were paying a big dividend and promising to increase the dividend, and the way they were paying for the guns and butter was to borrow money or issue more stock. They were diluting the stock. That made me uncomfortable. That's not good financial management. They really weren't meeting their dividend payments. They were borrowing money to do that. There's another word for that. It's called a Ponzi scheme. Now, I'm not accusing them of that. It wasn't consciously illegal because Rich Kinder is your typical Texan. Bigger, better, the future is going to be nothing but brighter, let's keep building. But I started to get worried about his approach. He felt that the money would come in to cover the dividend payments fairly quickly. And the stock kept deteriorating, and frankly, it was a very uncomfortable summer for me because we have a lot of people in this stock, even though we reduced. A lot of you, I either took you out or I reduced you. Some of you had 10 to 12% of your portfolio in this stock at the beginning of the summer. And I said, and if you remember, you'll see the email, I think I sent it out in June, said I'm taking it down to about a 5% position. Still believed in the company, still believe in the concept. Anyway, it bounced a little, and then we got into November, and they did something that really bothered me. On their September quarterly call, back in October, about 6 weeks, 7 weeks ago, they said they would not be planning to come to the capital markets again until the end of 2016. We've got enough money to cover everything, we're doing fine, because the analysts were starting to ask a lot of questions. Not a week later, they issued a preferred stock. It's confusing, it was called a mandatorily convertible preferred stock, and it was due in 3 years, and basically it was going to pay 9.75%. When any company has to pay 9.75% to borrow money in a 4% world, there's something wrong. And that's when I got really alarmed and started unloading the stock. I hung in, as Eileen will tell you, because she heard we were out to Catalina for her birthday, and I'm going, oh God, what am I going to do? Everybody owns the stock. And I was just miserable the whole time I was sitting on the computer. But when it broke this chart point here at around 24, I sold it. I just had to do it. And it's really hard to let go of an old friend that's made you a lot of money. Now, this looks horrible. If we could take this all the way back to 2003, almost everybody booked a very nice profit, even though the stock gave up a lot this year. But nevertheless, I had to do that. And for better or for worse, this was one of the reasons that portfolios underperformed. Between Enterprise Partners and Kinder Morgan, the energy sector has been hurt. Now, in the case of Kinder, where there was smoke, there's fire, because you can see what it did after we got out of it. It just has collapsed. It was the largest trading stock on the New York Stock Exchange yesterday. They announced that they were dropping their dividend from 51 cents a quarter, or $2.04 a year, to 51 cents a year. All right? I said when I wrote, in fact, if you look at what I sent to you, I said I don't understand how they can say they're going to raise the dividend. They should freeze the dividend. They don't need to raise it to keep people involved. Anyway, I guess you'll all have a judgment as to how well a job I did with this. At least you know I'm watching. I didn't just let this thing go completely off the rails. But in my judgment, we're going to keep Enterprise partners. Enterprise is a very different situation. They're covering their dividend. They're not borrowing a lot of money. And they run a very efficient ship. I might change my mind. But Enterprise has been hurt. Nowhere near as much as Kinder. But Enterprise has been hurt, and I'll tell you why. I don't think it's particular to Enterprise. If you look at the entire pipeline space, it's fallen along with oil producers. And a lot of people are not distinguishing between oil in the ground, which is now worth a lot less, and oil in pipelines, which is basically in transit. You're getting a toll for transiting. You're not holding it, you're not investing in it, you're simply acting as a toll road. And I like owning toll roads. But a lot of investors don't understand that. And when everybody was all hot and bothered to own oil a year and a half, 2 years ago, and throwing money at ETFs and at mutual funds in oil, these funds owned oil and gas producers like an Exxon or a Devon or an Anadarko, but they also own the pipelines. Well, as their shareholders start to dump shares, just say, get me out of oil, I don't want anything to do with it, what are they selling? The baby with the bath. They're selling the pipelines along with, and the good pipelines along with the oil producing companies. So far I'm planning to hang on to Enterprise. Overall, things are good, in my opinion. Every time you turn on CNBC, you're going to hear somebody saying that we're about to go into a recession, that we have problems, and the Institute of Supply Management Manufacturing Index was off a little bit last time. The dollar is strong. That's a real positive thing. It allows American corporations to acquire foreign corporations, which is actually a positive. It gives us a lot of power. It allows us to import goods and pay less for them. We don't have inflation because the dollar is strong, and we do import a lot of things in the United States. Gas and oil are cheap. We just discussed that, didn't we? Overall, it's not great if you're an investor in an oil drilling industry. But if you are a consumer, which all of us are, this is incredibly, incredibly positive. Oil is the lifeblood of our economy. It's not just about you getting from A to B. It's about trucking getting from A to B. It's about ships on the ocean. It's about chemical manufacturers having their raw materials cheaper. And Goodyear, people like that. At every level, if oil and gas are cheap, I mean, we lived through a generation of high oil prices, and everybody was wringing their hands about how it's ruining the economy. This is a huge positive, and it's still filtering its way into the economy. It's not great if you live in Texas, I admit that, but overall for people, it's very good. Interest rates are low, and unemployment is way down. Interest rates, we know the Fed, the market or the media is making the biggest deal out of a Fed interest rate rise. Big deal if we go up 0.25%. We are at the lowest rates in American history and in anybody's living lifetime, and going up 0.25% ain't going to change anything, okay? And I think it's already in the market. I'm just not worried about it. Unemployment is way down. Now, some people dispute the government's unemployment numbers. They say a lot of people aren't even looking for jobs. But I think most of you will agree, if you talk to people you know, they have jobs. They're working. People are busier than they were certainly 3-4 years ago. And that means they have money to spend. And that generally is good for our economy. Okay? There's always going to be somebody saying a negative. Well, unemployment's down. Well, that means there's a labor shortage in the building industry. The dollar is strong. Oh, well, that means the corporate profits are going to be hurt when they're repatriated. If they have a foreign division, it's going to hurt corporate profits. Gas and oil are cheap, but it's hurting Texas. Interest rates are low. Yeah, but they're going to raise them. Watch out. And you know what? They won't lend money to anybody. There's always a negative voice out there in the world of finance, and I try to get through that, the wheat and chaff type thing. And even Darth Vader thinks things are good. Make sure you get out to the new Star Wars movie. So that's my opinion if you want to know the underlying feel. But we're not likely to go into some huge boom, which is what characterized past economic cycles. They come along, it gets really great, there's always a bubble of some sort. There's always some area that everybody has to buy, and then it crashes. Really, right now, we have a steady growth, and I attribute this to demographics. In the United States and around the world, in China, in Japan, and in Europe, we have the largest group of older, retired or semi-retired people that we have ever had in human history. And in my opinion, that's not a bad thing. Older people are not impulsive shoppers, all right? They're not just borrowing money to buy anything they can, all right? They're not buying new cars too often, right? I mean, I do my financial plans for some people that retire and say, well, I'll buy one every 10 years. Okay, that's not going to make the car industry boom. They're not buying new homes generally, okay? They're not borrowing money. That's probably a good thing. I had a graph. I didn't bring it. I didn't put it up here, but it shows that household debt is falling in the United States, which had been a problem of it rising for many, many years. It's going down. They're not starting new businesses, and right now we have a lot of baby boomers that are still working later than they want to save for retirement because they're realizing they haven't saved enough, and that actually is something that's going to prevent the economy from overheating. If you remember that word. So investor psychology is cautious, but I think it's going to improve. I think we've got basically one of the underlying things is that home values have recovered significantly. And they say the wealth effect, when people feel good about the value of their home, they're willing to spend a little money. They're not being really, really cautious and scared. And what this graph is from Zillow, and I know a few of you are from Fullerton. This is home values in Fullerton, and so roughly $1 million house in 2007, during the recession and the big sell-off in real estate values, dropped down to about, I don't know, what is that? I don't know, 750,000? It's pretty much come back, not quite, but we've had a significant recovery in home values. That's good for people's mental attitude and their willingness to spend and their levels of confidence. And retail spending is quite good. We'll see what the Christmas season is like, but it seems like it's healthy. And the big surprise is auto spending. People are buying cars like crazy. Now, not all of that money is going into the United States because there's an awful lot of imported cars, but people are out buying cars. And they say the average automobile in the United States is 6 years old. Traditionally, it's been more like 3.5 or 4 years. So there's room for people to buy more cars and for more room to grow in that particular industry. And here is where I've been waiting. We're all holding our breath to see the millennials start spending money. These are your, in some cases, grandkids, great-grandkids even, but this is the kids, or people, they're not kids anymore, born between, say, roughly 1980 and 2000. They're in their early 20s or in their 30s, they're getting married, they're having babies, and they're pretty traditional. Most of them are still renters, but they want to, from most of the surveys, get out and have a house with a little yard for their kid to play in. You know, pretty traditional values. It's hard for them to afford a house. The banks are being very, very tight in the way they're lending and who they're lending to. Kind of horse after the horse got out of the barn type of thing because they were too loose in lending going into the Great Recession. But there's 80 million of these people forming households. All right? Just like the baby boomers in the 1970s and 80s drove up home prices and drove the economy, this group, even though we have a lot of older people that are not big spenders, this group is likely to be, and I have to believe that that is good for the economy. And one of the reasons we own the XHB, the building, Home Builders ETF, is I think we're going to see something move there. They haven't done much so far, but I'm pretty optimistic about what's going on in home building. So, this year ahead is not going to be easy, in my humble opinion. I think the volatility is back in the stock market. I think there's going to be a lot more whoop-de-doos. I will do my best to minimize them. The media is always looking for the bad. Foreign economies are a worry. China has been slowing down. Europe seems to be coming back. They're doing what they can, but they've had a lot of bumps there. The Volkswagen scandal has been bad for Germany. All the new immigrants, we're not sure how they're going to be able to absorb it. Actually, a lot of the Europeans want the immigrants because they need younger workers who will work kind of minimum wage people. But I do believe that companies that have a purpose, that have a meaning, that are going to serve human needs, because we have a burgeoning population, we have older people that need medical help and medical technology, and we have a whole new generation coming, that these people are going to thrive. So I think there's going to be plenty of opportunities. All right, we've got the presidential election year. Now, count on this, and I want to be real careful on politics here, because we've got the whole range in the room. But expect crazy statements from both sides, okay? And it's going to bump the market. When Hillary Clinton says she wants to control drug prices, down go the pharmaceuticals, okay? Donald Trump was railing about Amazon the other day, about Jeff Bezos. I think his hair gel didn't arrive on the next day like they promised him on Amazon Prime or whatever. But we're going to see some interesting things happen. It's going to be a lot of fun, and expect the market to do some moving and some jumping around. You heard that. I got it. I like this one. That Trump, they say Trump is tone deaf. He's got a new slogan. He said, "Are you better today than you were 4 wives ago?" That's his latest campaign slogan. So, anyway, it's going to be an interesting year. Where's the opportunity? Well, I was sharing with Mike and Teresa, I think, about technology. I think that that's an area, frankly, where I'm weak and I need to learn more and to find more opportunities there. I thought you might get a kick out of this. This was from the RAND Corporation. It's from 1954. It's what the home computer would look like in 2004. Okay? Got a steering wheel and everything. So I guess we've made some progress. But I'm looking at things with internet infrastructure, something to support the internet, because that will continue. In fact, that is expanding as the way to communicate. There's going to be fewer and fewer people using phone lines to get on their computers. It's going to be this little guy, your jackknife in your pocket that does everything from give you a flashlight to tell you where to drive, to read a book, to give you your music collection, etc., etc. It's an amazing age that we live in. I'm big on medical technology, and in about 3 weeks I'm going to Las Vegas for the Consumer Electronics Show. I've never been there. I've always wanted to go, and I'm going to do what they call the medical track, medical technology. I'm going to go to a lot of lectures and shows and and try to learn about this. I'm looking for new ideas in this area because I do think that there's a lot of promise there. But, I did want to show you this. My way of handling it so far has been to deal with something simple, cell phones, all right? Mobile communication. And I hope your holiday doesn't look like this, but it's becoming more and more of a familiar thing. Everybody's staring at their phone at the dining room table. However, we're going to facilitate that by owning a company called American Tower. This has been a pretty good stock for us. We began buying it in 2013, right when it started to make this move up, right around in here. And it's been a great stock, made a new high at the beginning of the year, or actually late last year, and basically has gone back and forth with the rest of the market. During the year, they bought all of the cell towers of Verizon. All right, why would Verizon sell their cell towers? Because they feel that they can apply that money, which they got about $6 billion for this, to improving their network and the quality of it, and going to what they call 5G or higher speeds and higher data rates, etc. They need that money. They didn't want to tie it up in real estate, which is what cell phone towers are. So they sold it to American Tower. And I've been watching the company for a while. All of their metrics are good. They seem to really understand what they're doing. They really understand how to take, for example, there was some nervousness about the buy on Verizon. We looked at it, did they overpay, etc. They did a very careful analysis, and they explained it to the analysts that it makes sense and it pencils out, and I was convinced anyway. I'm hanging on to it. But here's where I think the real growth is in the third world. In the United States, 84% of the people are connected to the internet, okay? In China, it's 45 to 50%. Average for the world is 39%. India is only 15%. India is going to have the world's largest population probably within 5 years, surpassing the Chinese. India has now got a business-friendly or a more friendly government, the most friendly government they've ever had under this fellow named Modi, and they're trying to drag them into the 21st century, and the Indians want communication. They're not going to build telephone lines all through that country. It's all going to be cell towers. And American Tower bought a large cell tower company in India this year. If they're not the largest, they're the second largest in India, and they have towers in every one of the, they call them circles in India, but the districts where cell service exists. I think this is going to be a big driver for the company, so I have high hopes. So at this point, my approach to technology is Apple and own the real estate under cell towers, because it pays rent. It's something very solid, and frankly, it's something I can understand. And I thought this was kind of cute. Did you want to change out your thing? You good? Okay. Anyway. All right, so let's summarize. We have the most vibrant economy in the developed world here in the United States. If you look at all of the indexes and all of the indicators, it's the USA. We're doing better than anybody else. We have among the world's lowest interest rates, but they're higher than a lot of other places, so we're attracting capital. For example, if you're a German insurance company and you need to tie up money for your insured people and for your annuities, okay, you can get a minus rate if you want to invest in Germany, or you can come to the United States and get 2%, and that sounds really good. So there's plenty of capital coming into the United States, which should keep interest rates down, and that's positive for the economy. We have the strongest currency and will continue to, because we pay higher rates than a lot of other people, and most people believe we can be counted on to continue to do that. Let me go back to that. We have well-regulated financial markets, and I realize the bankers and Wall Street hate that. I don't have a problem with that. I'm not a banker at Wall Street. I know some of you think of me as a broker, but as you understand, I'm your advisor. I work with those people. I worked for those people and got out of there 15 years ago, okay? They're not the nicest people. They're not, Mother Teresa, all right? And they need to be regulated. And I don't think they're over-regulated. I think the fact that they're not allowed to, for example, that the banks now have to keep an interest in every loan that they make, particularly in real estate, which they didn't have to before. So they'd loan to anybody, turn it over, package it, and sell it, like a hot potato. That can't go on, and I think that's a positive. And people around the world have more confidence in us if we have a well-regulated market. We have better checks on rampant speculation, and I think I just alluded to that. It's not that easy for people to make bad loans or bad investments and just pass them on. This is a real positive, and I think we're all grateful for this, the best security and military apparatus in the world. And we've had some terrible news the last few weeks, but we still have, I think most people would agree, probably the safest country to live in. And that, again, gives people confidence in the financial world and our financial markets. We have the best innovators in the world, all right? The iPhone didn't come out of, Mexico. It came out of the United States. Google, the internet itself, okay? Think of all the advantages and all of the technological developments we've had. Pretty much they've started here. Apple was started in the United States. And I think we're still going to have that, and people come from the rest of the world to do business here. And we have energy independence. And I gave you the negatives of that if you're in the energy industry, but it's overall a huge boon, and I think that's going to continue to give us some momentum. So to wrap it up and summarize, I've always tried to own what I call cash cow businesses. A business with some type of a unique moat or a dominant market position that has a lot of free cash flow coming in, and hopefully is sharing that with us and with you in the form of dividends. Okay? I don't mind if they take on some debt, but I watch the debt levels. And one of the things that worried me about Kinder Morgan, and one of the reasons I got out, is their debt levels were rising too high. So we try to watch out for that. I want to remind you, right now we have a pretty high position in cash. Depends on your particular portfolio, but it's one of the higher positions we've had in the last few years. It's not because I'm bearish, but I'm being disciplined. I want to be really disciplined and only buy things that are cheap and compelling. So I'm holding on and looking for those, and I ask you to be patient about that. And I do seek to own volatility absent or low volatility investments, because that's what will scare people out of the market, and I don't want that to happen. So the long-term, goal for you, as it always has been, is to have you sleep at night, go on vacation, volunteer for your church, put an addition on your house, whatever it is you're doing, and not having to feel like you got to go on the computer every morning and say, oh my God, did we make money, did we lose money? That's not what life's about. And I hope you'll allow me to continue, and my staff, to continue to facilitate you in having a life and not worrying about your financial situation. And thank you for being here. I hope you've enjoyed lunch.